I'm told there are none. Confirmation of the agenda. Thank you, Andrew. Thank you, Barry. All those in favour say aye. Aye. Against, carried. Thank you. Disclosures of interest. I would just remind everybody that it's important that they keep their interests up to date, and it's their responsibility. Do any members have any new interests, excuse me, or interests pertaining to the agenda today that they wish to disclose?
Yeah, I'm council of chain which trades as irons and has accredited councils.
Thank you, Paul. I'm sure we'll get that noted in the minutes. Has anyone else got any updates that they wish to declare at this stage? I'll take that as a no. So we have a mover and seconder to just note Paul's updated. Thank you, Pamela. Thank you, Andrew. All of those in favour say aye. Against, carried. Thank you. So that moves us on to matters arising. Janine.
Thank you, Mr. Chair, and good morning, members. Happy to take the report as read. Most of the matters noted from previous meetings have either been closed out or are included in today's agenda, and to help inform that. Probably the remaining matter that will stay there probably until the next study meeting is item number 1, which is a report on benefits planned and achieved to date from the Shovel Ready program to come back to a future meeting.
Thank you. So we'll move on to the item 5, the economic outlook and impacts. Sorry. Okay. So can we have a mover and seconder for the, thank you, Barry. Thank you, Paul. All of those in favour say aye. Against, carried. Thank you. So we'll move on to the economic outlook report.
Just being set up.
Are they?
Sure that
Okay.
there's a presentation.
We're making the thing where that we're living. Our station of it.
Yes. Yes, significantly.
There are a lot of opportunities. But now, households are saying they think it's now more stuff. So it's quite challenging to be a household saying, really probably large houses. I guess probably so much no longer money out now it's the households. If you look like this, you look at the outlook, that's really basic. I would say now you would it is very much stuff. You and I and everyone else know what. So it's giving authority.
Speak into the
Oh, yes, absolutely. And so you can see there that the hit from Omicron, yes, it was a hit. It wasn't nearly as substantial as what we saw through level 4. And you have, since the move to orange, seen a bit more of a bounce back in spending. Now, just to contrast those first 2 points, and this is where we get the feeling that something is coming. Households are currently spending all right. They're upbeat enough, they're getting cash out there. But they report that things are looking their worst on record. So there's a feeling that things are all right this second. A lot of people's mortgages haven't turned over yet, but the feeling is that the mortgages are about to turn over at some point in the next 6 months. And when that hits, that's going to be quite a large reversal in just how much cash is available. If we look to the next slide, what you will see is that locally things are even more upbeat, if you will. You'll see the orange line there, the likes of the Waikato region spending trending above the national average, a clouded or basically in line as well with Bay of Plenty regional average. So just to highlight that we're seeing a number of our regional areas still performing all right. When we look below that, what we're seeing is the likes of Hamilton City not spending quite as strongly. That's a trend we are seeing across a number of urban centres because again, people are still working from home. They're still not operating quite like they used to. But you can see somewhere like Waikato is spending quite a bit stronger. Again, very strong provincial economies coming forward. We're seeing all that money coming out through the likes of higher dairy prices and what have you, all of that contributing to things better. The two takeaways here, I guess, is one, that regional average is above the national average, so you can still see the momentum here in the Waikato region. The second one is also making the point that all things are starting to slowly trend up. The third hidden point is that if you look there, you're looking at the likes of spending up around about 10% above 2019 levels. Now, with inflation over just the last year at 7%, you add on the inflation from the year before, and you're probably not seeing a huge amount of additional volume going out there, but it's still momentum holding up all right, all things considered. So showing that there is momentum still in the economy, but again, we're sort of struggling to really start the rocket ship going a whole lot faster because all of those challenges and disruptions. Moving to the next slide, what we do see, and one of the largest challenges really that has emerged is very much around the labour force. Now, the start of this year, the only talk of town was inflation, for obvious reasons. Inflation's still a very big topic, and I'll get to that shortly, but I think at the moment what we're hearing is just finding people to do stuff is nigh on impossible. And we see that because at the peak of Omicron, we had over 300,000 New Zealanders each day that weren't able to go to work, either because they had COVID or because they were isolating as household contacts. And that sounds bad. What probably concerns us more is that since then we've still seen over 100,000 each day across the country unable to do it. So for all of the talk of we're moving on with COVID and similar, it's still hurting quite a bit. 100,000 people out of the workforce each day means that those delays on construction, on roading projects, on getting stuff delivered, on being able to have cafes open and what have you continues to persist. The risk of course, the health officials tell us is that there's a new wave likely to come through during, and so we're concerned about, well, if there aren't people to do work at the moment, if we're trying to get the economic motor running ahead at the same time as we don't have as many people able to do it, that's a pretty tough challenge. If we look into the future, one of the issues, and we move to the next slide, one of the biggest challenges is, sorry, it's always disconcerting hearing your own voice. If we look to the next slide, what we do see is that those pressures as well are coming across in a number of different areas. If I can just get that next slide up, please. Thank you. And I guess that's important where we look across the region, you can see that just about everyone is growing. So it's not just a few sectors that are trying to bring in new workers and keep that economic momentum going. It's just about everyone. You'll see a massive increase in construction, which is good given the amount of work that needs to go on. It is a pandemic, so it's useful to see that the healthcare sector has also expanded. And then you look at the likes of professional services and similar, very high paying jobs. Often, obviously, people are looking at moving into the region, working from home a lot more and similar. Just to note the decline in the primary sector down the bottom. Now, that looks like job losses, if you will. Really, it's an inability to fill what are a number of roles across the primary sector and similar. So I guess the key point here is that if you look again across relative to pre-pandemic, just about everyone's either got more jobs or wants more jobs, and at a time where we know that 100,000 people across the economy aren't in work, that is a challenging environment. Moving to the next slide shows us sort of just how difficult that is, because at a time when we see a lot more jobs across the economy, we know that businesses would like a lot more people as well. The number of job ads at the moment sitting 150% above pre-pandemic levels, substantially higher than what the national average increase has been. So broadly speaking, across the entire economy, if we could, we'd try and grow the employment workforce by 1% just in total, snap bang immediately. That would be even larger here in the Waikato region. So it just goes to show at the moment, again, trying to find people to do work is a real difficulty. And see, this is where we get into the doom and gloom. If we go to the next slide, the difficulty is well that, man, if you think that it's difficult to try and find new workers, you're actually struggling to retain your current staff. What we're seeing for the first time in a long time is that businesses are now reporting that there is the highest labour number of sort of poaching, if you will, labour turnover in the economy since the 1970s. So it's all good and well that you've got 250% job ads, you're trying to reach out and grab new people. Well, you've got to keep your hand pretty firmly on the people who are already at their desks, because they are very much looking to leave. There's people that are moving around quite considerably. So again, just adding to that picture of it's going to be difficult to grow. We know that there are every industry wants more jobs. That's a huge level of competition for talent. There's a lot of additional work that needs to be done. We know that there are more people isolating. We know that there are more people moving around, but at the same time, trying to keep the economic momentum going. It's just a very, very difficult scenario. And the last sort of part of that, if we move to the next slide, the real kicker, if you will, it's probably lucky that I'm here and that a number of young people are still around in New Zealand, because it seems like the exodus has begun. Now, the exodus is a little bit over the top, but I think it's important to note that after having 50 to 60,000 people usually come into the country every year, we now have a net outflow of New Zealand talent, particularly young people. So over the last year across the country, we've seen a 15% increase in the number of job ads. At the same time, the working age population, 15 to 64, has declined by 0.2%. The youth population, 20 to 29, has seen a 3% fall. And so we're very much starting to see that talent go overseas. And the difficulty as well, again, trying to expand the economy, trying to keep things going at a time when we apparently don't have all that many people, and the current talent that we're losing is starting to bite as well. So some real disruptions, some real challenges there when it comes to the labour market. And if we go to the next slide, now the managers and bosses in this room probably won't like to hear this, but at the moment it is the best time ever for a worker to ask for a pay rise. From a very serious point, and also from just how the economic trends are going. On a serious note, if you're not getting a 6.9% pay rise, you are going backwards in real terms. You're not able to buy the same amount of stuff with your paycheck as you were the year before. That's a pretty compelling argument, especially at a time when, given everything I've just shown you, it's very much the sort of thing where a lot of people are going to be going, well, look, there are other opportunities out there. Someone is willing to pay me more money because there is such a talent shortage across the economy. So we are seeing those wage pressures increase. Now, there's a whole bunch of ways that we measure that. This is a very simple one. We take the total earnings bill across the economy. We divide it by the total number of people that are earning that money. You can see there that earnings per filled job across the economy, and it's the same for Waikato and the same for just about every region of varying degrees. You'll see that has not only increased to the highest point on record in 20 years, but it's increased at the fastest pace to that point in 20 years. And so very much some big shifts underway there. So that's the labour market challenge out of the way. The difficulty then becomes just general cost pressures, right? If we move to the next slide, what we can see is that if you give inflation an inch, it will take a mile. Now, let's be clear, when we studied inflation as economists, we took all of 2 weeks to go through it. Lecturers told us we killed that beast in the 70s, 80s, 90s. It's done. Don't worry about it. It's back. That dragon has been revived. Now, to give you an idea of how high inflation is at the moment, 6.9%. I wasn't even born the last time it was this high in June 1990. Importantly, my parents had just started dating at the time. So it's been a while. But the pressures that you can see there are huge. Now, the point I want to make here is you'll see that we continue to lift our expectations around inflation. The difficulty that we have is that the longer it persists, the more that it becomes entrenched. So people think that prices are going to go higher, therefore they push their spending, or pull their spending rather, into the here and now to get ahead of those price increases. And in doing so, they actually increase prices even more, because effectively all of these price increases are showing is that the economy's got this many people and this much resource to do stuff, and we're trying to do this much. That gap is inflationary, because it means that if I want a house built and you want a house built, we're both going to bid as much money as possible and go tit for tat until we get that house built to be the first one there. Same house, no change at all. It's just we're paying a huge amount more for it. And that is a real challenge. If we move to the next slide, one of the key drivers of that has been freight costs. Now, we know across the world it's still costing us about 5 times what it did to move a container globally. Now, good news is that it's stopped going up so crazily silly over since about mid last year, and it's even started to push down in more recent times. But you'll still see it's going to be a slow climb back down the other side of the mountain to try and get those freight costs back into a more normal level playing field. And importantly, we're worried that given the Chinese lockdowns recently, that there could be a huge amount of manufacturing increase that comes out of China, which starts to hit all the US ports and European ports, and they go, well, we've barely been able to cope with reduced levels of imports at the moment. Now there's a huge flood on its way. Maybe things could well turn worse. So challenges there around actually getting stuff. We know there's quite a backlog still to be filled, and it's very expensive to move stuff around. Moving to the next slide, the other big challenge, of course, is finding and the cost of various materials. If we look at the likes of bitumen prices across the economy, we can see that those are extremely high relative to what they've been in previous times, and very much trending upwards. This is data, I think, up until March, April, and it's gone up even further since. So the cost of from a council point of view of delivering different services, this is just one indication. We look at fertilizer, we look at pipes and concrete, we look at aggregates. Just about everything is increasing in price quite substantially, and that is quite a key hit. If we move to the next slide, and this probably is the kicker, of course, the Russian invasion of Ukraine has further disrupted things. Now, nothing was good before COVID, before the start of 2022. In fact, prices were very high. The outlook now is for even greater challenges, because of course we've seen those fuel prices and similar start to increase. We've continued to see that disrupt things further down the chain. It's not just the likes of fuel oil, it's also food-based oils. So 75% of all of the world's sunflower oil comes out of the Eastern European area. That's put massive pressure on the rest of the world to be able to try and feed themselves. So food prices are going higher. The likes of steel prices have gone higher as well, along with a number of other precious metals, aggregates and similar, because of the price of moving them around, gas and energy generally. So it's a pretty bleak picture when it comes to energy prices. What I think is important to highlight, and the reason I've added this chart very late in the day, so thank you very much to staff for being able to bring it in, is that expectations continue to be that things get better. I think that's the wrong expectation. I think it's mad to think that all of a sudden there's going to be a huge flood of new oil. We're going to get over this war. Someone's going to win and everyone's going to take off their restrictions and go, well, wasn't that, something that we did last year? It's going to persist for a while. And you can see that the markets have had to try and react to that. Now, what I've charted for you here is the price, the future price of oil based on what month people were when that expectation was set out. So you can see that the dark blue line towards the bottom was what you were seeing in February before the Russian invasion of Ukraine. The dark blue line above it coming through in March after the Russian invasion had started. Yes, it had lifted quite a bit at the start, but people were still expecting it to trend back to sort of $80, $90 a barrel US over the course of the next year or so. You'll see that every line after that has continued to pitch higher, and that grey line there for June starting quite a bit higher than those previous lines. So the expectation now is that even when it ends, it might end up at around about $90 a barrel still, but the feeling is that it holds up for a while yet. All of that being very difficult, of course, when it comes to actually being able to take into account those cost pressures. If we look ahead, the other difficulty we've been talking about it a little bit as well with the next slide is residential building costs are also quite high. Now, again, I've put in quite a long time series here just to show how unusual these cost inflation levels are, because everyone says, well, haven't we seen inflation before? Well, not like this for quite a while. At the moment, we're seeing the highest increase in building costs since the 1980s. And so, again, the differences that our economy now faces, the difficulties that it also faces, are immense. The bad and the good news, if you will, is moving to the next slide, is that there's an expectation of some sort of relief, if you will, but it takes a while to get there. What I've charted for you here is our expectations of where the likes of residential, non-residential, and civil, so network infrastructure costs go into the future. Now, when I present this to a number of building clients over the last year, they've said, well, it seems pretty mad that things come back to sort of 2% within a few years. Realistically, if we were having 6% on 6% on 6% year after year, things would blow out. You'd have to literally double your budgets for most projects pretty quickly. The difficulty, I guess, that comes through here is that, one, it takes a while for this inflation to calm down. You'll see that when we look at the likes of both non-residential and civil cost inflation, it's still running at 6% by the start of 2023. So the entirety of this year is going to see some persistently higher cost increases. More importantly, anyone who's waiting for things to ever become cheaper seems to be kidding themselves, because we're not expecting that these numbers ever go down. The price of delivering projects now remains and will remain for the future at a considerably higher level. If we move to the next slide, to get all of this under control provides some very, very difficult options. And realistically, there is no silver bullet, but it comes back to what I said before in very simple terms. We're trying to do this much work in the economy, and we've only got this much resource and people to do it. try and get that down, what we need to do, because we can't just click our fingers and magic up more people, more oil, more materials, is we have to bring demand down. The Reserve Bank is working quite hard on that. They're playing catch up by raising interest rates considerably. Very simple idea there is that the higher the interest rate, the more you pay on your mortgage, the less money you've got for other things, and therefore less demand generally in the economy. Now, that's all good from a macroeconomic point of view, but we know that one, there are big distributional hits to some households who are going to be paying quite a lot and going to be struggling to afford it. Two, from an organisational point of view, that makes the cost of borrowing much more expensive and therefore much more difficult to deliver on various projects and similar. Now, what you will see here is that the Reserve Bank is very much playing catch up and having to move quite swiftly to try and get those prices under control. And that does see a considerable further lift in interest rates over the next year or so. Our current expectation is 2 more back-to-back 50 basis point increases to the official cash rate, taking the OCR to 3% and taking those borrowing costs even higher still. So the outlook there is very much inflation goes high, therefore to combat it, interest rates have to go high too. A very difficult position from this organisation's point of view. And that comes at a time, if we go to the next slide, when there's a huge amount of delivery still going on. If we look at the amount of network infrastructure that Infometrics is expecting, this is across the entire region, not just delivered by council, but across all organisations, there is a fair bit to do. Some of the near-term peak in work is very much some of the energy projects, Tauhara 2 down in Taupo and similar, but you'll see a very stable level of over $1 billion each year needing to be delivered going forward, and that again, sort of probably a lowball estimate in the sense of that's all of the publicly available information that we can find. So it comes at a time we're going to need more investment. We're struggling to find resources, but there is a fair amount of stuff going forward. We're getting close to the end, and then we'll get to questions. Don't worry. If we move to the next slide, there's an expectation as well. All of these interest rates and similar might finally help us get to something better when it comes to the housing market. That's sort of true, sort of not. If you look here, what I've charted is the Treasury and Reserve Bank's expectations for house prices over the next few years. And you can see that there's expectations of perhaps up to a 10% drop. Now, that's all good and well. The point I guess I would make is that all of that comes after a build-up of over 30%. By the lowest point that Treasury expects house prices to get to in September 2023, house prices will still be 32% higher than they were pre-pandemic. At the same time, wages will have increased by 18%, inflation by 17%. For every step forward that the average household takes with their earnings, they'll take one step back at least with inflation, while the house moves about 2 or 3 steps further ahead even still. And at the same time, interest rates have increased as well. So you're paying a much higher interest rate on a still very expensive house. Yes, there are some drops to come. Yes, there are some differences in the housing market and things aren't staying at such silly high levels, but don't kid yourselves that affordability is coming anytime soon. Again, the distributional impacts are probably the key one here. We know that some households will be fine. They had a mortgage before COVID. They had some cheap money in recent years, and now coming up the other side, they're going to go back to what was normal. They just need to adjust their spending a bit. First home buyers and those on lower incomes and similar are going to be hit a lot more when it comes to the disruption that is starting to hit them, and so a difficulty there when it comes to their ability to afford rates and services and similar. And just lastly, final slide, and we've talked a lot about COVID. I think it's important to recognise the other issues that have never gone away, but were put to the back seat, put on the back burner during COVID-19, the likes of our climate response and similar. I guess it's just worthwhile noting the likes of here, I've charted per capita carbon emissions according to Stats NZ by region. Again, only up until 2019. I guess probably if you look at the fourth line down, the yellow line there for the Waikato region, you can see a good profile of sort of declines. I mean, on a per capita basis, it doesn't look like quite as much, but there's still a decline in there. A bit of a tick up over the last year, but I guess just a feeling again across most parts of the country, there's still a lot more work to be done. That transition is going to be costly. It is going to be a big disruption to the economy, and it is going to be quite challenging to achieve at a time when we know that, particularly with COVID, short-term thinking very much is the highlight of most households for very good reasons. You know, if you're seeing inflation hit you in the pocket right here, right now, it doesn't really matter what the future looks like quite as much, but a feeling that we do have to get on with some of these much more pressing issues because time is not our friend on any of these occasions. And so feeling that after the disruptions from COVID-19, we are starting to pick back up some of those wider challenges, the infrastructure deficit, climate change and similar, housing affordability, poverty and what have you, are just as important, but COVID-19 certainly won't go away. With that, very happy to take your questions after a fairly doom and gloom expectation of how the economy is going. But I guess a fair warts and all assessment of what's going on, because from your point of view, I expect, having that information and being able to think about what it means from an organisational perspective, but also what sort of mitigations might be worthwhile putting in place is more important than being able to be told that everything's cherry and things are all good and swell, because they are challenging. We do expect growth, but it is going to be more difficult to eke out that growth in 2022.
For a very interesting presentation. Do committee members have any questions of Brad?
Oh, sorry, I've muted myself there. Just to the point that I thought it was important to highlight that that was coming back on stream, and wanted to be able to put a chart up of there with a bit more local information. I mean, very much take the point that, I mean, if you look at especially those top four or so, I mean, there's a huge amount of other things in there. It's not consumption, it's production based, right? So you've got TY in there, you've got the likes of Methanex and similar in the Taranaki oil fields. Here you've got a huge, bread basket and food production. Like, the point was more that it's coming back on stream. It's the sort of thing where we haven't talked about a lot of that for a long time relative to how much we've been focusing on COVID-19. So making the point that's coming back on stream, but take the point in terms of all the other disruptions and similar. I guess the difficulty is there's probably never a good way to measure that, in a sense. If I'd shown you gross emissions, it probably wouldn't look good. If I looked at it on a GDP per capita, well, we'd ask about the components of GDP and similar, but very much take the point there. Energy prices, we can hide more than most other countries because of our renewables. Now, I say that because I think it was 2 months back, Europe was looking at a 600% increase in their energy prices because of gas and natural gas coming through from the likes of Russia. So, I mean, we just simply don't have that level of exposure. We do have the level of exposure to the likes of diesel and petrol prices, and we're seeing that quite significantly, even with the government's reduction of 25 cents a litre on petrol prices for average households. Petrol prices are now back at the same level that they were before the government put that intervention in place. So big difficulties in place also because you go, well, the government says they're going to take that off at some point in the future. That's going to become difficult when they want to increase petrol prices by 25 cents a litre overnight, presumably come August, September. I guess the general point there is, because of our renewable focus, we don't have quite as much exposure on the energy front. What we probably do have, and what's leading our inflation a bit more, because energy is very much driving what you're seeing in Europe and similar, the driver of the likes of inflation in New Zealand is, very much petrol and the transport costs that associates with and how that percolates through, but also the fact that we are trying to do more than the economy can resource. And so part of that is around domestic production and similar. Because of that, one of the reasons I talked about how it was going to be difficult to grow, the feeling is that we're going to have to be importing quite a lot more product from overseas to try and actually fill our resource gap, because we know that all of our people are already utilised and all of our resources are being done. Key case in point, everyone's been talking about jib over the last few months. We know that a lot of companies are now importing it from other parts of the world because we can't provide all of the plasterboard and fiberboard here. The first point was around regulation and dairy and similar. I mean, I think at the moment what we're seeing is that there's still a lot of nervousness and or caution about what that actually looks like. You know, the pathway still isn't settled. He Waka has only just come back in a sense and still hasn't been fully put through by government. So there's a feeling of still not quite sure exactly how that plays out. But we do know there's a huge amount of pressure coming on the primary sector at the moment, given the regulations and probably the costs associated. Now, that's at a time when we know that farmers are facing the likes of very high prices for fertiliser, for feed, difficulty finding workers and similar. I guess the broader comment there is we know that we've got to do something. We've got to ensure that we balance those economic outcomes, which, you know, provide the money to be able to do all of these other things with the environmental impact. I don't know if it's fully right at the moment, but I think we've also got to the point where we can't stick our heads in the sand for too much longer, which I fear not necessarily here. There's been a lot of work that has actually been done here locally and same over in Taranaki, but I feel like generally we've always sort of skirted around the issue a bit when it comes to general climate change issues, but also how the dairy sector is regulated continues to shift.
One of them, and I suspect it was Clinton, repealed the Glass-Steagall Act, and that leaves me wondering, you know, as I know, as a member of the first world economy, is our reliance on fiat currency still well-founded?
I think broadly it is, and I think from a point of view that we know that we've got to continue with something that works rather than trying to sort of look at something that doesn't quite as much. I mean, the likes of going back to when we traded with shells and similar isn't really going to work quite as well. But I think we've also got to acknowledge that we've got to front up to the debts that we've taken on. We know that we've, you know, we've printed a huge amount of money, not only here in New Zealand, but across the world to get through COVID-19. Now, that was the right move. And sense we know that we had to be able to get the economy through. We'd find it much more of a challenge if we had the likes of you know, hundreds of thousands of people unemployed and an economy in a crater. But we also have to pay that back over time. We've also, particularly here in New Zealand, got to balance out the repayments of our debt, which we know we have to do so that we have our rainy day funds again, and similar with the fact we need to invest quite significantly in a number of areas, particularly our network infrastructure and what have you. So debt is always seen as a bad thing, I think, a lot of the time. But I think, again, it's because the talk is often that we live within beyond our means. If I asked everyone in this room if they've ever taken out a mortgage before, then everyone who put up their hand has lived beyond their means for very good reason. You don't wait until you've got the entire house price before you buy it. So there are very much good investments, but there's also the difficulty of if we're starting to use our debt positions and the printing of money and similar to fund operational spending, ongoing spending day by day, that becomes a very financially difficult position. I think we've got ourselves in an all right area at the moment. We know that we are able to continue to repay our debt. We know that both from a government point of view and a local government point of view, debt levels are low relative to the rest of the world. That gives us scope to increase. But I think we've also got to be quite cognizant of the fact that we need another rainy day fund, because there is going to be something more. It might be another pandemic, it might be the Alpine fault going, it might be a huge storm event. All of those are very much live options. We continue and have seen them throughout New Zealand history. So I guess we do have to continue to operate in the fiat currency realm, but we've also got to be quite aware of the difficulties that come with that, especially as we try and push the boundaries quite significantly at quite a fast pace.
Thank you for that stimulating presentation and for your answers as well. Thank you. Can we have a mover and second to receive that report, please? Thank you, Andrew. Thank you, Barry. All those in favour say aye. Against, carried. Okay, we move to item 6, internal audit activity update. Janine, is this you?
Yes, thank you, Mr. Chair, it is.
Hold on.
Hopefully with, the magic microphone, the travelling microphone. Hopefully with KPMG staff to join the meeting. I think they were scheduled for about now, so to present the legislative compliance review, which is probably the substantive matter for this agenda item. They're not in the meeting yet. Okay. In terms of the other areas within the internal audit program, so there is the cyber security response. And my apologies, the report does say that that's included in the agenda, but that will come back to you in September instead. The legislative compliance work, which is being reported back, and the flexible working policy or flexible working review. Now, you might have noted in the report from KPMG that they do note around that review that the contract with KPMG for the provision of audit services through Waikato LAS is currently being renewed, so it's expired, up for review. And so if we want to progress with that flexible working review, we will need to do that at the moment under a separate arrangement, which we can investigate whether there's any cost penalty to doing that separately. Okay, so we're just following them up.
Maybe I would better to move on, come back when they're here, because
Yeah,
I
so
don't think we can.
I think it makes a
would
lot more
need to-
sense for them
yes.
to answer the questions or to present the report. I know they were restricted in terms of their time availability, but
Okay, so we'll come back to that. Can we move on to item 7, page 60? Risk management activity
so the
update.
risk management activity update. So I guess if I maybe introduce this with the review of the strategic risks and the status of those in terms of appetite, trend. We're reporting effectively across those strategic risks that the current risk ratings haven't been changed since we last reported. Now, I think the reality of it, as we've just heard from Brad's presentation, around those aspects of planning and financial sustainability, certainly for planning, there was a bit of discussion around should it be increased or not, although noting that we already have that as a post-control status of high, but the financial sustainability that is sitting at medium, which is specifically around our infrastructure assets, should that be increased to high, particularly reflecting those inflationary pressures and supply chain issues. I think the reality at the moment is that we are continuing to see delivery of our infrastructure works program in an accelerated infrastructure works program through the Shovel Ready program. So currently we are able to actually execute those plans as we need to and within the budgets, but I think this is very much a watching brief in terms of how that plays out. Also noted overall, just in terms of our plan for next year, of doing a bit of a risk assessment of that. So, you know, council had already set its budget effectively in February this year. The world has tilted slightly on its axis over that time. So what does that mean for us in terms of our ability to actually deliver with what we said we were going to do in the next financial year? So that process has been kicked off through the executive leadership team with the intention of bringing something back through the Finance and Services Committee around any potential impacts on levels of service or how we go about mitigating some of those particularly price risks and delays to being able to deliver the program. The chief executive has left the room. But so I was just going to come back to page 61 of the agenda, 61 and 62, which was information that was included for the committee in response to a request last time of some insights and commentary from the chief executive around those current and emerging risks. So that information is provided and from an elected member perspective is largely consistent, I understand, with what the chief executive had spoken with you about after the council meeting about the things that are exercising his mind at the moment in terms of impacts, external impacts largely on the organisation. We've talked a lot around the uncertainty created due to the external economic environment. The one that we probably haven't touched on is really around those relationships with partners and the degree of change that we're seeing across the sector, both locally at both a political and a staff level, but also across the regional sector. And of course, coming into our own elections, that some of our members have already indicated that they won't be seeking re-election as well. So just an acknowledgement of that relationship risk.
Thank you, Janine. Questions? I'll take that as none. So we have a mover and seconder that we receive the risk management activity update. Thank you, Pamela. Barry, thank you. All those in favour say aye. Against, carried. Thank you.
So I hear from the CEO, or we're taking that as read from the paper?
When he returns, we can go back to that. We can speak.
So it looks like we've got Tanvi in the meeting from KPMG. So here we are. Oh, and David on mute.
Right.
Good start, isn't it?
So we'll go back to item 6. Welcome, David. And,
Good morning.
Sorry, I can't read your name from here.
Tanvi.
It's Tanvi.
You're on mute, David.
Again. Oh.
No.
Oh, I shouldn't be. Can you hear me okay?
Oh,
Sign language, David.
oh.
Can you hear me now at all?
We can hear you when it comes to the surfaces.
I can hear you loud and clear in the room.
Sorry guys, if you just wait just one moment. We're just sorting out
Sure.
some technical difficulties.
Alrighty, can you hear us now?
We can hear you loud and clear. Can you hear us okay?
We can hear you, and that's as loud as it goes, I'm afraid.
I will try and talk loudly then.
Pamela, can you hear?
Let's see how we go. Come closer.
Oh. Turn it around, so. Yeah. So
Yeah.
Let's see how it goes. David, the floor is yours.
Thank you very much. Nice to see everybody, and yeah, hopefully you can hear me. But please sign out if sing out if you can't. So I'll quickly talk to the overview, which is on page. Starts on page 22, and then we'll talk specifically to the report that we've issued in the last quarter. So at the program level, there are the 3 reviews on the current financial year plan. The main one from our point of view, being the Legislative Compliance Framework Review, is in the papers, which we'll talk to, as I've said. There've been discussions around the Flexible Working Review, but we're still yet to land that scope. And I guess one of the other aspects we've flagged in the update is, of course, that our contract expired on at the end of May. So we've been in talks with the CoLab around renewing that contract. Where that doesn't occur, then it'll either be an RFP or we'll be contracting separately with individual councils. So I think we're hoping to hear back from the CoLab on that point in the next week or so, and that may firm up the direction forward. So perhaps if we then move to the compliance report. So I'll perhaps just frame up give some opening remarks, then Tavi can talk to some of the key observations that we made. We first reviewed compliance back in 2016. When we're talking about compliance, we're talking about legislative compliance. And the review wasn't deep diving into specific areas of legislation to look at compliance. It was more looking at it at a higher level. So looking at the framework, how does Waikato Regional Council manage the broad number of legislative aspects that they need to comply with? How is that governed? How do we assess where we should prioritise our focus? How do we provide training so people understand what they need to do, policies, reporting, etc. So we've assessed the framework across a number of different aspects. I think one of the key aspects we also did as part of this review was to survey staff to get their perspectives on how well supported they felt or understood legislative obligations. And a key piece of context also is just around the committees and councils' risk appetite for legislative compliance, which is low. So to us, that says that it is important that we have a structured, robust approach to managing legislative obligations. So overall, we used a maturity model to assess the framework. In 2016, that was at an initial or low foundational rating, and that has certainly moved up. And I'll get Tavi to talk to some of that progress and the recommendations, but there's certainly room to do further and to continue to mature and enhance that compliance framework. So Tavi, do you want to just talk to some of the areas that have been action since 2016 and then just summarise some of the key themes from the report?
Sure, David. So I think it's been quite a journey for WRC since 2016 when we have done the previous compliance review. I think the key things to be focused on was, development of a compliance policy that kind of gives some guidelines in terms of, what are the roles and responsibilities in terms of managing those compliance obligations, and what are some of those monitoring and reporting requirements and the escalations that's required on those obligations as well. So that was kind of documented to provide some initial guidance and direction to the staff members on the back of that review. Followed by some improvements made in terms of the reporting aspects, in terms of what gets, escalated or reported to the risk and the audit committee. And this is more in terms of, what are some of those emerging obligations that WRC should be looking at, and what these are and what it means for WRC from compliance perspective. I think the main one was there was a vast list of legislations. So this was more in terms of making sure that people understand what are the specific roles and responsibilities as assigned to them. So a review of the obligations and how those get assigned to the staff members across WRC, that was performed on the back of the review as well. So those were some initial good kind of steps that were taken on the back of the review. And I think we have also noted that, in light of there's a strong commitment across WRC to ensure that they comply with the legislative obligations and how those are being managed as well. So there's a strong governance that has always been there since 2016. So that's really helped progress some of the next steps in terms of uplifting the compliance management practices across the organization. On the basis of this review and some of the interviews and the survey responses that we received, I think the key one was understanding what's really relevant for WRC. And I think the key recommendations or the finding that we have come up with on that front is, doing a risk assessment of what are some of the main or the most critical legislative obligations that are relevant for WRC, the high risk ones that really matter. I think the importance of that is, prioritization of, where do people or staff members spend their time, or, where's the requirement to spend more kind of resourcing or more of, structuring of the processes that will really add value for WRC. And once that's sorted, it will, kind of help aligning the roles and responsibilities in terms of what are the things that need to be centralized, because, you can have some of those synergies to kind of work in favor, and some of those themes coming out of it to be, identified, and then, centralized actions to be taken to manage those as well. So that's the first step. And I think that would also then follow into identifying what are some of those targeting training requirements that people need a hand with at the moment. And I think that came out as a very common theme from those surveys and the interviews that we have done, is more in terms of identifying what are some of the specific things that are relevant for their roles and responsibilities. And I think a wider awareness around, availability of Comply Watch, or the Comply With kind of, or any other external kind of legal services assistance that might be available to them as well. The next one was in terms of once this is identified and when people complete their Comply With survey responses, for the most critical legislative obligations that are identified, it is to say what's really the responses that people have provided, what's the rationale and supporting evidences that they have attached to those one. This is more to identify if there are common themes coming across that can be actioned on the back of those responses, and any kind of an independent assessment that may be required to kind of do a bit more deep dive or thematic review on basis of those responses as well.
And certainly to avoid, a tick the box mentality, which I think complacency can creep into these types of processes. So having that not interrogation, but due diligence across the responses can help to avoid that situation occurring.
David, that was one of the things that that the survey responses, especially, it came out as a major one in the interviews, in terms of saying that, if there's nothing that requires additional information to be provided, then it just become a tick in the box activity, and we don't want to be going down that way as well. And then lastly was more in terms of the reporting. So while the reporting is provided to RAC, it's more in terms of, how do we kind of structure it more to highlight what are some of those key areas that really need uplift, and what are some of those key action areas that are being implemented or being planned at the moment as well. And also in terms of the new legislative environment, is that becoming more of a risk? And if so, who's really responsible for those ones, and what actions are being taken, and how are those being managed, rather than more generic, update to just say that these are some of the additional compliance risks that we should be worrying about.
So I think wrapping it all up, the risk assessment is quite critical. From personal experience, having run compliance at Telecom back in the day, that really helps to crystallize where you're putting focus, both from a training point of view, both in terms of investment and mitigations, reporting up to these types of committees. So I think doing that process will be very valuable and would actually help to move things quite to higher levels of maturity quite quickly, and potentially without greater levels of resource being required. So I think that is quite a key aspect. but doing that shouldn't, should be a relatively pragmatic exercise, and you should see benefits of that coming through quite quickly. Things like training will take longer to develop, but again, basing that investment off the risk assessment will make sure that that's a focused approach rather than a broader, thinner approach. I think we'll just stop there for any questions.
Thank you, David. Any committee or members have questions?
Chair, David, just to get clear, you think that the reporting to the RAC should be better, but you're not going to say where. You think we should go and do a risk analysis first and then work it out for ourselves? So you're not identifying any areas that the reporting should specifically be better. Exactly.
Yes, to a degree, Paul, but I suppose we're saying we'd like to have the reporting come out to the RAC reflecting those key risks, so it's clearer to the committee. For telecom, it was Commerce Act, Fair Trading Act, and there were 2 or 3 key areas of legislation. Now that's where we focused board reporting to say, what are we doing in those areas of legislation? So the risk assessment will have that prioritisation, but it should be very clear through the RAC reporting.
Been around it for a while. You must have some idea what you think the key. I mean, you've just given us the telecom list, and I can understand that. Is there off the top of your head, would you have a similar list here or not? Or was it...
I wouldn't off the top of my head, Paul. Sorry, but I think it's a key thing that the regional council needs to work through.
David, how did WRC compare to the other councils that you have insight into in this area?
Look, I think the regional council is actually ahead of the territorial authorities, the district councils. Most do have comply with, so that's fairly widespread throughout the sector. But I think generally I would say that most of the other TLAs are at foundational levels of maturity. So I think we're certainly not saying that the regional council is behind, but I think with that low appetite for risk around compliance, we feel that there's certainly areas to move forward, and I don't think it's we're conscious of making sure it still was cost effective. And sat well with the risk appetite of council, but I think these recommendations are a good step forward.
So Dave, with the comply with solution, are you suggesting that there's an overview of the answers at some point or periodically? So
yes.
People ask why you gave the answer, or is it? Yeah, is that the type of review you're talking about?
Yeah, that's exactly it, Paul. We see this in the banks, and I'm not using the banks as a comparison, but the banks put a lot of effort into, with any director attestation type surveys, they have a lot of interrogation of those results. They require a lot of evidence to be placed alongside those to prove effectively that attestations are robust, and then they triangulate the results of those surveys with other issues that have come up during the year. What are things that they would have expected to have seen come through those surveys? So we're looking at a slightly lesser, but trying to pick up some of those key principles in the comply with surveys. So yes, you do have an overview testing of some of the responses coming through to beef up the hopefully the robustness. And making sure that people are aware of that review of the results so they don't become complacent.
And the rationale and the supporting evidence will only be for those key obligations that are identified on the back of the risk assessment that is done. And I think the idea is also to say that, once we identify some common gaps, can that also be the source of information to do some thematics or deep dive reviews in future as well? So that will become one of the input points.
So if we're talking about getting evidence to support answers, I guess we're risk-based again, aren't we? We're not going to do it for the whole check. We're looking
that's exactly right. And that's why the risk assessment is so pivotal. It allows us to invest and spend more time on the most important things rather than getting a scattergun approach where we're trying to cover off. I mean, there's so many. That list of legislative obligations will be a very long list. So getting really clear on what is most critical is really important.
Right. Any more questions? Oh, good.
I'll just turn my sound on. Look, I'm confused by this report. And it seems, when I read it, I thought, well, they've boiled the ocean and recommendation making. Let me read one recommendation for agreed management actions. Management will consider enhancing the reporting, including commentary to the Risk and Assurance Committee. That sounds a little bit vague to me. And from Tambi's presentation, I would have thought there was enough people interviewed that she would be able to say to us, for example, the number 1, number 2, and number 3 legislative risk that we thought was important. I thought that's where you were going with your question, Paul, is A, B, C, and D. Whereas I don't get that clarity. This to me, I found it a particularly hard read. Sorry, David, because it doesn't fill me with confidence that we're driving risk down in the organisation, and it maybe it does, and maybe I'm the odd one out. So I'd be interested to hear what my colleagues around the committee think. But if someone around this committee could say, here's the top 3 actions that come out of reading this report, I'd be really interested to see what those are, because I suspect, Chair, they'll be different for all of us.
Look, I take the feedback, but I guess in terms of the report, the executive summary is quite clear on the key actions. It is to risk assess and to prioritise the vast list of legislative applications that need to occur. It is then to use that to focus training so people understand what they need to do. Thirdly, it was put more robustness into the comply with survey, and the 4th one was to enhance reporting back to this committee largely based on the results of the risk assessment. I just want to clarify, the scope of our review was not to tell you what the top areas of legislative obligations were. Our review was over the framework for how WRC manages its legislative obligations. We could come back with that list, but that wasn't what we were asked to do. That would be for management to work through. Perhaps bring that prioritisation back to this committee to check. If you would like us to review that, we can do that, but that wasn't the purpose of the review specifically. We were looking at a wide range of aspects that come together to provide the compliance framework for WRC.
I certainly can support the need for independent validation. I've recently seen a independent review in comparison with a self-assessment in risk management, and the results were frighteningly different. So if you believe that would help us to improve the value of this approach, I think we should seriously consider doing that, because I'm heartened that we are better than the other councils you're seeing, but I like Andrew, I'm struggling to really see how we can take steps to move this forward. Yet I think we need to. Janine, you want to say something?
Thank you, Mr. Chair. And David, probably just a question for you or for your feedback. So when this report has been shared with the executive, one of the comments has been that those key areas of legislation are also reflected through, I guess, the strategic risks that the committee is looking at as well. So interested in your feedback in terms of how those things work together, or could or should work together, because that's actually taking a risk lens across the operations of the business, which inherently will include legislative compliance within.
Yeah, I see it an alignment. Janine, it's a good question. So, we have a legislative compliance critical risk that you track at this committee, alongside the other 10 or so critical risks. I suppose it's similar to health and safety in some ways. So you have an understanding. Health and safety is also in that paper as a key area of risk. This committee then gets updates on, what is happening in that health and safety space, and it provides some insights as to underneath that corporate level risk. What are some of the key areas of risk that are specific to health and safety, and what are we specifically doing on those elements? It's the same for legislative compliance. So you've got a corporate risk level. At the highest point, you kind of have an assessment. Yes, we feel we've got moderate risk or whatever it might be against a risk appetite of low. The reporting up to the RAC should help to expand out slightly that level of visibility for the committee, so that they get a sense of, okay, these are our 5 top areas of legislative compliance from a risk point of view. Are we okay? What are we doing in those spaces? Are we training people? Have we got a backlog of training? Have we had any issues? Are we pretty comfortable with our mitigations? Our roles and responsibilities clear? So it gives the committee more ability to do due diligence over that risk area rather than at the sum. Now the deep dive, if you're doing deep dives into those risks, which I believe you are, that would be a point in time also probably get to that level of detail, but this is more operationally every quarter, giving comfort that those highest priority risk areas from a compliance point of view are being managed.
David, so please excuse me if I didn't understand the report, but because I've read the bits where you've got the respondents, what's your overview on the cultural response? Do you think, what's the culture towards legislative compliance? So you talked about the capability in the systems and opportunities for training. That's one thing. But the sort of willingness or desire or engagement with the issue of compliance, what's your feeling on that?
I might get Tavi to add to this because she delivered the results, and I suppose the survey results are also relevant to that. It felt to me as if there was a good culture and people recognised their responsibilities. Yep. They just wanted a bit more clarity and support around that to realise or to understand what their obligations were. Tavi, would you agree with that?
Yes, David, completely agree with that statement. So I think we have highlighted governance and culture as one of the strengths for WRC as well, and that's based off the commitment and the tone, even from the executives right up to the directors within the individual areas as well. I think they do understand why this is important and what needs to be done. It's more at the lower level, and the ground level, in terms of being more clear in terms of who needs to do what and is responsible for what, and what's really the support that's really available to them. So I think it's more in terms of the clarity, in terms of the support that is available, like I said, through the external legal advisors or through additional training that would really help with uplifting those areas as well. But generally, the culture is really good across WRC to make sure that people understand what's required, even at a generic level, and are working towards it.
And I think,
So
Paul, oh, sorry, Paul.
Since last time, we're on a journey of improvement. There's some things we can do, and one of them is the deep dive into risk prioritization, if you like. And the second one is that we can look at some of these answers, which I agree, the game should do, not all the time.
Yeah.
Okay, I'm kind of happy with that. And so your answer, am I happy with it? I'm happy with it. Yeah.
Andrew, do you want to say something?
I guess I'm just interested. I'm just interested in what's the executive going to do different as a result of this report, really. What's the top 3 things you're going to change as a result of this?
So I think that there's a few things, and a number of them are already in train. So a training module as part of staff induction around risk and compliance is being developed, so that will capture people as they're coming into the organisation to understand their context. I take on board.
Sorry. Are you saying that when they come in here, there's going to be a conversation that goes like this? You're now working for a regulator. Here's a bunch of regulations that we're accountable for, and you might find yourself on farm being the judge of an infringement against some legislation. Just give me a little bit more granularity around actually what's going to happen?
So the program is still being scoped for development. I think the reality is that there is a general risk and compliance approach for induction. And then as you step into those specialist areas of the business, there needs to be more specific training and support provided around those obligations and risks that reside in the business. That I don't think there's value in generalised training. It needs to be very tailored to the role. I take on board the comments in terms of the assessment of key legislation across the business. And so the team are working on a program to actually work with each directorate to understand what that looks like. And I think the other point is considering the periodic, and I think it is periodic, review of the evidence provided around compliance to give that independent view. I think that sense of complacency is a potential risk, particularly when you're faced with a comply with survey that has a lot of questions in it, to actually really make sure that we're getting the gold from that in the areas that we need to know about and we're taking action on.
Just on that review, you could do it like a simple stock take. I wouldn't go and do a review of every single question the first time around and have that one just disappear into a hole. So some cyclical review where you're just stepping out again, asking some people about some questions so we're not overloading the team.
Yeah, and I think an area
And probably risk focused.
to start is where we know we have partial and non-compliance that's being reported and being reported fairly consistently. So, you know, the team are gathering that evidence, but actually seeing some of that trend information. So where does our risk actually lie from what's happening now? I think with the degree of reform and legislative change, our risk profile in this space just continues to increase as we actually take on board new legislation and the impacts of that. So it is an area that we need to be on it.
Right. If there are no more questions, I think we'll, so I have a motion and second to receive that report of internal audit activity.
I'll move, Chair.
Thank you, Paul. Thank you, Barry. Second. All those in favour say aye. Against? Carried. Thank you.
I'm against.
Oh, you want that recorded?
No, just want you to know that they're against it.
Okay. Thank you, David, for your report.
Thank you very much.
Okay.
Have a good rest of your meeting. Thank you.
Thank you.
So we'll go back to item 7. Chris, Janine covered for you while you were out of the room, but I think, but I think it would be appropriate on that report.
Thank you. I didn't realise you're going to. Do I need to get my microphone off? I didn't realise you had going to flick so quickly through it when I was talking to Brad out the door. Look, I guess I did give a what's on my mind type of update to councillors recently, and some of what was on my mind is what got reflected in the paper, particularly on page 62. I don't think a lot has changed since then. Certainly in terms of, you know, like what Brad was talking to us before, that high inflationary environment, you know, what that means for our work programs or operational programs. And we're doing a lot of work just to identify that, to make sure we can work within budget, supply chain issues, keeping a close eye on that, the tight labour market. I guess if there's one thing which was particularly of interest to me right now, and it's discussions I've had with the Chair of Council, Barry Quayle, on a number of occasions, it is that staff retention and remuneration factor. You know, particularly, I suppose, talking to Brad out the door, culture can go so far, but especially people on, probably all people, but those on lesser incomes are probably feeling the effects of inflation even more than most, and especially if they're in mortgage type of environments. And it's what we're doing as much as we can to ensure that we can keep staff and attract staff to the organisation. The political things that have been going on in council, particularly surrounding the removal of the chairperson and the ongoing judicial review. We've been doing a lot of work to try and ensure that the council's, the reputation of council's maintained. Decision making still strong, and I believe that to be the case in council. The other thing I note in there is probably a looming issue, or it's of interest, is the amount of change that there might be in local government at this elections, because we've already got 5 mayors in the region have indicated they'll be stepping down. So that's Matamatepiako, Thames Coromandel, Rotorua, South Waikato and Waikato District. That's what we know of at this point in time. There's 3 relatively new chief executives in the area. So there's in the leadership of the local government and region, that type of change will be something we need to keep an eye on. And yeah, so that's the main things. One of the things we've been doing in council to try and improve the iwi relationship space is we've started training our councillors at PLT, which has been interesting. And the other thing we're doing is we're starting our competency improvement program that will particularly staff, and we'll start the induction of your councillors on the program as well.
Thank you, Chris. Do any committee members have any questions? We don't. Can I have a mover and seconder to receive that report, please? Thank you, Barry. All those in favour say aye. Against, carried. Thank you. We move on to item 8, the Waikato Regional Council Climate Change Response Update. Karen.
Good morning, committee. What prompted am I on? Is the mic on here?
No.
No, you're not.
Yes.
Does.
Yep.
Can you hear me okay? Yeah, it's on. Right. This report in your agenda on the climate change activities and risk mitigation was requested by the committee at its March meeting. As I understand it, you were interested in what council is doing about climate change, how we're communicating these activities, and what might we do to further reduce our risk as identified in the corporate risk register. I'll take the reporting agenda as read, but just quickly reiterate that responding to climate change is a cross-cutting issue, and all parts of the council have responsibilities to decarbonise their activities and build resilience and ensure business resilience. The council's climate change response work programme is focused on providing the evidence base to support good decision making, coordinating and integrating operational activities, managing risk, measuring and monitoring progress in our emissions reduction programme, and sharing information, supporting our EV partners, and collaborating with our stakeholders. With respect to what more might we do, work is underway to plan a comprehensive business case to inform the next long-term plan. And this will provide the Council with options to increase the pace of its response to the changing climate. Meantime, with any decision or action, we are encouraged to ask ourselves about adaptation. Is this decision or action future-proofed in line with knowledge of the future climate and an increasingly carbon-constrained economy? with respect to mitigation, that's the emissions reduction, does the decision reduce emissions? And if we know, by how much? And if we don't know, can we find out? And then the leadership option. Does this decision help show the way toward a climate future that will give us a better tomorrow? So, stop there, Chair, and just invite questions.
Don't know which sound that we're going to go with, but whatever. I'm interested in how we look at this report and align it with what we heard this morning from Brad Olson on economic output impacts. How do we as a risk and assurance committee look at balancing the effort that's going in here with the risks that we just heard, which are dramatically changed over a short period of time? So I'm interested in the work around this space and how it will respond to the challenges that we're now having to face. So there's some obviously going to be pressures as to where we put our emphasis.
Indeed, and this is the work that we're doing as part of our long-term planning and looking to the future. And the risk right now is short-termism, particularly in the climate change area of work, because we have huge pressures across all sorts of, and we're talking about multiple crises, aren't we? People talk about the climate crisis, we talk about the crisis of search for talent, we talk about the housing crisis. There are all sorts of competing demands in front of us right at this moment. But when we consider our response to climate, it is looking beyond 2050 to 2100. And so we have to bring to bear all of those different pressures, and it is a balancing act. And that's why we are looking to the core well-beings. And we have just talked about the sustainable infrastructure decision-making framework that does take a holistic view of our investment choices and the options we would make to actually deliver on those outcomes.
So let's talk about the well-beings. What risk is that, Karen, that we're going to make some decisions as a result of the work that's been reported here that will exacerbate what Brad Olson showed us on slide 6, which was a negative impact on the primary sector. Do you think that there is any risk to the capital that's deployed in the primary sector in the Waikato as a result of the actions of this council?
Of this council?
Yeah.
Well, this council is looking to work with our agricultural sector, for example, which is why, for example, the water quality has been taken over a very long time frame, recognising that it takes time to adjust. It takes time to adjust, and certainly with respect to capital flows, we need to avoid the risk of stranded assets. We need to get most efficient use of capital, and that can't be done overnight. And that's why all of these decisions we make are done holistically, but also with a view for transition over time. And we have had people from the government's Just Transitions unit here talking with us about supporting communities to understand their risks and how to adjust those. With respect to climate, for example, and our agricultural sector, as Brad said, we're still working through the recommendations that the primary sector partnership has put to the government. The government is digesting these against the Climate Commission's advice, and then we'll come back to New Zealanders with whether they accept the recommendations or if they have alternative views. And at that point, we'll have better understanding of how this council will respond and work with the agriculture and climate sector.
So let's be a little bit more specific and granular. Say I own 200 hectares of peat swamp that has been converted to pasture. Our roadmap is taking let's doing a LiDAR audit of all of the developed peat. I guess what I'm asking through you, Chair, is I'd like to have some comfort that our executive walks a mile in the shoes of the people who for generations have invested, for example, in developing peat farms. Because when they started developing peat farms, it was the wild, wild west, and going on, no one knew. And there's serious amounts of capital now invested in some of those dairy farms on the peat. I guess the question I'm asking is, you saw on that Waikato graph the impact of dairy, sheep, beef and industrial activity in the Waikato. And I guess what I'm asking is, as we build our feelings around climate change, I hate us to be too heavenly, any earthly good. I want us to be able to say, we're going to drive using regulations available to us, some new guidelines for farms in the Waikato. And we've done a lot of thinking because we've worked and held hands with Fonterra, Dairy Companies Association of New Zealand, Dairy Insight, and we know exactly the risk to the capital that this strategy will deploy. Because that's a different conversation to one that says climate change is our focus. We know that those peat swamps are emitting a huge amount of carbon, ergo we want cows off the peat swamp, and we want some sort of alternative that might involve letting that peat revert. I mean, that's a very, to me, that we're entitled to take that view as regulators, but I just want some comfort that we're applying a level of humanity that understands the impact we might be going to have on generations of family farmers that have invested dough and getting to where they are now, seeing in some cases tens of millions of dollars worth of assets suddenly volatilized overnight because there's been some sort of regulation change. Do you get a sense of where I'm going with this conversation?
Absolutely understand that, Councillor McPherson, and that's certainly the lens that's applied to all these conversations. And again, that's the intent of the Sustainable Infrastructure Decision-Making Framework. It's also to support those farmers and other landowners who are in the eye of the storm, as it were, with climate change, changing the actual physical state of their land. So how do we support them to adapt so that land is still productive, but maybe it's productive in a different way that accounts for the changing climate? And that's what we can support, and some work has been done on that. And the corollary of that, of course, is the drought strategy that we have to ensure that people can continue to work with their land as the climate changes.
Any other questions? No. Can we have a mover and seconder? Thank you, Andrew. Thank you, Barry. All those in favour say aye. Yes, carried.
Thank you, Commissioner.
I'm proposing we take a 10-minute break now because we're running behind and the next item is quite lengthy. So can we just take a quick 10-minute break, please? Yep, thank you. Thank you.